Welcome students. So in this lecture we will be talking about the accounting rate of return. Accounting rate of return or the average rate of return is the next tool which is also the non-discounting criteria, and it is largely based upon the accounting values or the accounting terms, and it's basically the accounting measure of evaluating the project investments, not the measure based upon the cash flows. So first four measures which you saw till now, they were based upon the cash flow. First three discounting criteria, that was NPV or the benefit cost ratio or internal rate of return or even the modified internal rate of return, they were based upon the cash flow, and we were discounting the cash flows, and time value of money was taken into account, and finally the NPV being calculated was based upon the discounted cash flows. They were discounted at the required rate of return or the weighted average cost of capital. In the one non-discounting criteria also, when we talked about the payback period method is the one out of the two non-discounted techniques. First one is the payback period method, and in that also use the cash flow. We didn't use the accounting values or the accounting terms, and even in the discounted payback period we use the cash flows. So only difference is that in the discounted payback period we discount the cash flows to calculate the payback period, and in the non-discounted payback period we don't discount the cash flows, we use the absolute values. So both the methods, maybe it's a discounted payback period or non-discounted payback period, we were using the cash flows. Only in this method we are using the accounting values or the accounting the output, or maybe anything when we are going to measure the return on the investment. Maybe it's accounting return, or maybe it's the average return, or you call it as accounting rate of return or average rate of return. They are based upon the accounting measures, not on the financial measures, not largely based upon the cash flow. So if you see here, it is written very clearly that accounting rate of return also referred to as average rate of return. So you call it as accounting rate of return or you call it as the average rate of return, because largely we use the average here. So its average rate of return on investment is a measure of profitability which relates income to the investment. So it's basically the accounting rate of return, or also referred to as the average rate of return on investment, is a measure of profitability which relates income to the investment, both measured in the accounting terms. Both measured in the accounting terms means both means the profit as well as the investment. Both are measured in the accounting terms. Since the income and investments can be measured variously, different methods of measuring the income and the investment are multiple methods are available. So they are in the accounting literature, or they are in the say accounting values, or in the accounting terms. There are multiple measures available. So we will use maybe multiple measures also, or maybe one out of many available, and anyone which we are going to use should be most suitable, more logical, and based upon certain fundamental factors, so that whatever that average rate of return we are going to calculate or accounting rate of return we are going to calculate, that is more logical and conveys the results of the business. So in this discussion we can see here that we have the multiple measures ranging from A to G. So we have the first one A, then A, B, C, D, and last one is G. So total in the 7 different ways, or in the 7 different methods, you can calculate the accounting rate of return or the average rate of the return. And for our purpose, for our discussion, we are using this measure, which is basically the second one, the B, where we are talking about that for calculating the accounting rate of return or average rate of return, we are using this measure or this formula, average income or profit after tax. Average income or profit after tax divided by the average investment on the book value. This is on the average investment on the book value. So under this method, what we do is that whatever the profit we are earning, we take the profit of that, means the average of that profit. Maybe it's a period of 5 years. For the period of 5 years, whatever the profit we are earning. For example, first year we earned a profit of 1000 rupees, second year we earned a profit of 1500 rupees, third year we earned a profit of 2500 rupees, and fourth year we earned a profit of 4000 rupees. So we will sum it up and calculate the average. So that will give us the average profit after tax or income after tax. So yeah, it has to be the profit after tax, not before tax. It has not to be the income before tax. So it has to be average profit after tax. So 4 years period we are taking here. So for example, if it is 4 years foreseeable period. So in the over the 4 years, how much profit you are earning, that has to be taken. Annual profit we have to take, sum it up and divide it by the 4. So that will give us the average income or the profit after tax. And for calculating the average investment, because it is on the book value, right? It's on the based upon the book value. So we have to take the initial investment. For example, the initial investment is 1 lakh rupees, and we are assuming that investment because it's on the book value. So naturally, when you are using that investment made into the fixed assets, into land, plant, building, machinery or anything, that's going to depreciate over a period of time. And we see that the scrap value is going to be 0. So we can say that total investment is how much? 1 lakh rupees. And what is the life of that investment? 4 years. So we can use the fixed installment method or the straight line method of depreciation. We can divide that 1 lakh by 4. So every year it's going to reduce by 25,000 rupees. So first year you will take 1 lakh rupees, second year you will take the investment as 75,000 rupees, third year you will take the investment as 50,000 rupees, and fourth year you will take the investment as 25,000 rupees. So that way you will get 4 figures, 1 lakh plus 75,000 plus 50,000 plus 25,000. So you sum it up, these 4 figures, and divide it by 4. So you will get the average investment. So on the numerator you have got the average profit after tax, profit of the 4 years, sum it up, divide by 4, and the investment. For calculating the average investment on the book value, initially take 1 lakh, divide it by 4, get the depreciation rate 25,000 rupees. So first year it is 1 lakh book value, second year the book value comes down to 75, third year it comes down to 50,000, fourth year it comes down to 25,000. So you have got 4 values, sum them up, divide by 4, so you will get the average investment. And finally, when you divide the average profit by the average investment, so you will get the average rate of return or accounting rate of return. So it's not based upon the cash flows, it's based upon the profit, right? We have understood the difference between the cash and the profit, but though in that way the profit is not comparable to the cash because cash is real and profit is nominal. But still you cannot ignore the profit, because before preparing the cash flow statement, when we started preparing the cash flow statement, and cash flow statement became the statutory statement in the late 90s, before 90s or late 90s, we were preparing only 2 statutory statements in any business or in all the businesses. That was income statement and second one was the balance sheet. So when it's an income statement, so income statement gives us the profit, not the cash. Only cash flow statement gives us the balance of the cash. So profit itself has its own relevance, right? So sometimes it can be a disguising figure because when the larger part of the sales are on the credit, so profit is also on the credit. But that's a different story. But profit cannot be ignored at all. So you can use here the profit, average profit after tax and average investment, and calculate the average or accounting rate of return. We have given here 7 measures for calculating the accounting or the average rate of return. But the most appropriate which I find here is, this is the second one, B. So there we will take the average profit. How to calculate the average profit I just told you, and average investment also I explained it to you. And finally, you can divide the average profit after tax by the average investment, and whatever the rate comes with us, that would be the accounting or average rate of return. So the beauty of this method is that it is based upon the accounting terms. It's basically accounting measure, not the cash measure. First 4, all the 3 discounting measures and 1 non-discounting measures, the payback period, that is also based upon the cash flow. First 3 discounting measures, NPV, BCR, and the internal rate of return, they are also based upon the cash flow. So we all understand cash flow is more relevant and more real, but you cannot ignore the profit at all, right? So accounting rate of return or average rate of return is the only measure which is based upon the accounting terms. It takes into consideration the profit, not the cash, and gets divided. Profit is divided by the, say, average investment, and that way we are able to find out the average rate of return or accounting rate of return. So this is the only accounting measure, and the remaining 4, 3 discounting and 1 non-discounting, payback period. Even payback period also to some extent you call it as a discounting measure, because we have started calculating the discounted payback period also. So all those 4 measures are based upon the cash flow. Only this one is based upon the accounting values or accounting profit, and we take here the profit and the average investment. Here is some quick assessment of basic evaluation methods, which one is good and which one is not good. So people may ask here that which one out of the 4 or 5 methods is good to use, practically how the companies are using or people are using it. So which one is better and which one normally we should use. And as an entrepreneur or maybe as a project promoter, it would be the question from your side, because you have not used it in the past. You're going to use it for the first time, even in the companies who are already into existence. And when they are going for expansion, diversification, and growth projects, for them also it's a challenge many a time that which method to be used, NPV, IRR, or benefit cost ratio, or we should go for the non-discounting criteria, payback period, and accounting rate of return. So I told you many times in the past that out of these 5 measures, right, out of these 5 measures, we have not to rely upon any one. Maybe it's a discounting or maybe non-discounting criteria. Even if it's a discounting criteria, you use maybe NPV or IRR. We seldom use BCR because it has certain limitations. So either we use the NPV or we use IRR. NPV is in the absolute terms, IRR is in the percentage terms. So depending upon the requirement, your requirement, you can make use of it. But always supplement that with the non-discounting criteria, where you can either use the payback period or you can use the average rate of return. So if you are using the payback period, and you are using the discounted payback period, so better it is you supplemented by the accounting rate of return, because this will give you an idea about the profitability of the project. So if you have an idea about the profitability of the project, you will have the idea of the cashability of those profits also. So normally it has some positives and some negatives. So out of the discounting criteria, NPV and IRR both are in use and people are using it depending upon their requirement. If somebody want to have the results in the percentage terms, they use IRR, and if people want the results in the absolute values or absolute terms, they use the NPV, and both carry their weight. Benefit cost ratio is not much in use. Out of the payback period and accounting rate of return, payback period people use, but because it has also become a discounting criteria, so must be, I think we should go for using the second one, average rate of return, because it is based upon the accounting measures and the profit, which is equally relevant for us. As well as the methods are concerned, they all are simple measures to be used. There is nothing complex in this, because these days we have all the table values, computerized systems on the Excel, all the formulas are fitted. So you only have to give the values and within a few seconds you can get the values. So it can easily be done. So we have to look at what is our requirement and how we have to decide on the use of any appropriate evaluation criteria. One thing I would help you to understand is that there was one survey conducted, which I will share the results of the survey, and that survey results help us to understand that which one is the most prevalent method. And if you go by the survey results, so the most prevalent method for evaluating the new investment proposals is the internal rate of return, followed by the payback period. So internal rate of return is a discounting criteria, and payback period is basically a non-discounting criteria people normally use. And out of the total respondents, 85% the respondents shared with the survey, with the people who were conducting the survey, that they use the internal rate of return. 67.5% they said that they are using the payback period. 66.3 they said that they are using the net present value, and some people use a break-even analysis, some people use the profitability index or benefit cost ratio also. So largely we can say from this survey results, practically you can say that most widely used method of investment evaluation is, or the capital budgeting evaluation is, the internal rate of return. And the beauty of the internal rate of return is that it's in the percentage terms. Other one is in the absolute terms. So that's the one important reason. And when you talk about the difference or maybe the use of discounting or non-discounting criteria, so discounting criteria is more in use these days because it takes into consideration the time value of money. And in the non-discounting criteria, people are using non-discounting also. But just to have a rough idea about that, in how many years my investment will be coming back to me, so payback period can be used, but people should use accounting rate of return also, because the profit is equally important, and accounting rate of return or average rate of return talks about the profit or the profitability coming out of that venture. Practically, people use multiple methods, they don't use one single method, and maybe both the discounting and non discounting criteria are means more in use. When you talk about the discount rate, I was talking to you in some previous class also. When you talk about the discount rate, so most prevalent or widely used discount rate in India is the 15%. That is the post tax rate of return is 15%. We assume that our cost of capital is 15%, or Indian economy's cost of capital is 15%. When we borrow the funds from the different institutions, or maybe from the stock market, or maybe from our own funds, the cost works out as 15% post tax. So discount rate normally used is 15%. This becomes the, you call it as a required rate of return also. So if the required rate of return is 15%, how much is expected rate of return available from the project? Accordingly, we can make a comparison. And after this completion, the discussion on the investment evaluation criteria, we will have the discussion on the risk analysis of the capital budgeting proposals, and there different methods we will use, but the survey results have proved that sensitivity method is the most widely used method. We will talk about the different methods of the risk analysis of the capital budgeting proposals. So there are different methods like sensitivity analysis, scenario analysis, or maybe the say other different kind of the analysis. So sensitivity analysis has been found to be the most widely used measure as a measure of the risk analysis of the new capital investment proposals. So mixed set of the methods we are going to use, discounted as well as the non-discounted criteria. Discounted, largely people are using the internal rate of return, and supplemented method means the additional method when somebody want to use this, they are using the payback period. But I think we should use the accounting rate of return more than the payback period, because profitability is equally a good concern, and we should try to understand that on the accounting terms, what is the rate of return available from any investment proposal which we are going to evaluate. So this was all a discussion on the different techniques, on the different evaluation, you call it as the criteria, project investment evaluation criteria. And we talked about all these techniques at length. We try to understand that for evaluating the new investment proposals, how we can use the concept of the time value of money, what are the different techniques which are based upon the discounted criteria, how we discount the cash flows. Though we have not learnt about, that will be the next part of discussion, that how to calculate the cash flows. We have not learnt about it so far, because we assumed that we are given the cash flow. But in the practical sense, cash flow will not be given to you. You have to work out the cash flows. Either you can have that information from the previous discussion when we had a discussion upon the estimation of the financial projections and profitability when we did. So there you can take the cash flows. We will have a detailed discussion on the estimation of the cash flows, that now means practically how practically the cash flows are calculated. But till now we assumed, while talking about the investment criteria, we assumed that cash flows are given to us, and how to evaluate the project proposals on the basis of those cash flows, both cash outflow and cash inflow. We learnt about the discounting process, and then finally calculating the NPV and arriving at that rate of return available from that investment or the project where the NPV becomes zero. So we talked about 3 discounted criteria and 2 non-discounting criteria. Out of these 2, one has also become a discounting criteria, payback period. So we can calculate both the raw payback period as well as a discounted payback period. Both are helpful, both are useful for us. And with the help of this, whatever the results come, at least we are going to get one important information, that by making investment into the venture, what rate of return we are going to get back. And that too based upon the cash flow terms, not upon the profit terms, because cash is the real, profit is nominal. So you are going to get to know that from this investment proposal, how much rate of return is expected. And you have to compare that with your required rate of return. So if the required rate of return is less than the expected rate of return, the project is very good. But if it is the reverse, that the required rate of return is more than the expected rate of return, the proposal should be abandoned. But in any case, if the required rate of return is equal to the expected rate of return, or expected rate of return is equal to the required rate of return, in that case we should go ahead with the venture, because by using this kind of the discount rates, your NPV will be 0, and that is our minimum requirement. Because from this foreseeable information, if you are able to make the NPV 0 at the earliest, so remaining time of the project will give you the surplus cash flows, and overall value of the project will become positive. So this all discussion we had so far, and now that in the next part of discussion we'll be talking about some of the problems, and these problems we will in these problems we learn about that how to calculate the net present value of the project, or how we can evaluate the different proposals available with us or given to us, and how we can make use of all those say information, all the cash flows, maybe cash outflow or cash inflow, for evaluating the project proposals. So we have two problems here. One problem is simply talking about that we have it's a simple case of calculating the net present value of the project, where we have the cash outflow on the one side. This is 10 lakh rupees of the cash outflow, and the project life is 5 years, and in this 5 years of the project life we have inflows. First year inflow is 100,000, second year 200,000 rupees, third year 300,000 rupees, fourth year 600,000 rupees, and fifth year you call it as the again 300,000 rupees or 3 lakh rupees. And we are also given the discount rate, right? The discount rate is 14% here, and we have to evaluate this project proposal by using the discounting criteria, and we have to calculate the NPV of the project, right? NPV on the basis of these cash flows. So if we are investing means 1 million rupee in this venture, then and we are going to have different kind of the or different values of the cash inflows over the subsequent foreseeable 5 years, and if we want to discount them at the rate of 14% being a required rate of return or a weighted average cost of capital, then what is the NPV, whether it is 0, negative or positive, we will have to find out that. And the next thing in this problem we would be learning about is that we will be learning about applying the time varying interest rates we will be learning about, and there we will not keep the say discount rate static, rather it will be varying discount rate we will be using, and we will use 12% in the first year, and over the years the discount rate will keep on increasing. Second year it would be 13%, 14%, 15% and 16%. So we are going to learn about this process with the help of this entire thing, and we are going to evaluate the different investment proposals by taking the inputs from the imagined figures which we have brought in here, and we are going to evaluate this project proposal by say applying the project investment or evaluation criteria. Both discounted and non-discounted criteria we will apply, and we will try to know about that how the project proposals are evaluated in the practical sense. Second problem is more comprehensive. We will discuss it in the subsequent class, and in this class we are going to evaluate two projects. One is project M, second is project N, and equal investment is required in both the projects. This is 50 millions of the investment is required, means both. If you go for the project M, 50 millions of the investment is required. If you go for the project N, 50 millions of the investment will be required. And out of this say information given, because you are given the outflow 50 million and inflow you are given for a project M 11, 19, 32 and 37, and project N 38, 22, 18 and 10 million, and requirements are these 6. Right, these are the 6 requirements. First requirements, what is the payback period for each project we have to calculate. So that is the say we will calculate both discounted and non-discounted. And then third question is, if the two projects are independent and cost of capital is 12%, so which project the firm should invest in? You have to evaluate it and take a decision and then help the firm to take the final call. And fourth one is that if the two projects are mutually exclusive, means in the third one you can take both, right? But in the fourth one, mutually exclusive means that out of these two, if you have to pick up only one and the cost of capital is 10%, so which one would you opt for, would like to go in for? So that we will evaluate. And the fifth requirement is that if two projects are mutually exclusive and the cost of capital changes to 15%, which project the firm should invest in? That's going to be our next requirement. And the last requirement in this problem would be that if the COC is 14%, cost of capital is 14%, what is going to be the modified internal rate of return? Though in this kind of the problems, a modified internal rate of return may not be required, but for example, in any case, we have to use the modified internal rate of return also. Then how we can apply the concept of MIRR, that we will also learn by solving this problem. So these two problems we will discuss, we will solve in the next class, and we will learn practically that for evaluating the project proposals in the practical sense, how we can apply both discounting as well as the non-discounting project evaluation techniques or the criteria. So we will discuss these problems in the next class. Till then, thank you very much, and we'll meet in the next class and discuss the two problems on the capital budgeting. Till then, thank you very much.